markets have been screaming higher since Halloween. The S&P 500, yes, it's screaming because it's Halloween, and your orange tie. The S&P 500, we know, advanced in 16 out of the last 18 weeks, Mike, and we have not seen a run like that, you say, since 1971.
Amazing.
Wow. So let's welcome you. Mike Giordano, financial advisor with Williams Wealth Management, is here. First of all, the why. Tell us why. Why has the market been surging?
Yeah, the market's always looking ahead. So if you think back to 2022, the market was seeing that the Fed was hiking rates, and that forced the market to kind of sell off. And then remember, all last year we kept going, when's the Fed going to stop? When's the Fed going to stop? When's the Fed going to stop? And they finally, everyone started anticipating they're going to stop around Halloween last year. And then the market starts looking ahead to when's the Fed going to start cutting rates. And so the expectation is if they cut rates, it stimulates the economy, and this boom can continue.
So how could this run possibly be a bad thing?
Yeah, it seems like there's no way it could be a bad thing on its face, right? If the markets are going up, people are making more money, perfect.
Yeah.
Here's the issue. Two things. Number one, the market was expecting all these rate cuts, and the Fed saying, we don't know when we're actually going to start cutting rates. The more important thing, though, is that you want to see the market kind of moving in line with earnings, because earnings is what drives long-term growth. So if you're hoping for your money to make a lot more over time, you want to just keep seeing earnings growing throughout the economy. And the market's been going parabolic to earnings. And so at some point, you expect there could be some sort of correction. So typically what you like to see is the market takes 2 steps forward, takes a step back, 2 steps forward, step back. Right now we're seeing like 5 steps forward, and the fear is that you could have a reversion of 2 or 3 steps backwards.
So now, did you bring a hat with you? Because I'm going to ask you to put on your psychologist hat. So how should we be?
Do they wear hats? I don't think psychologists wear hats.
Listen, you know you wrote that part. So how should we be thinking about our investments right now?
Well, first off, Gabby, I am not a psychologist, so I don't want any of the viewers to think that I am, but I would like the name doctor in front of my name. The way you want to think about the markets is a little bit the way you might talk to a toddler, right? When toddlers are screaming and they're throwing a tantrum, it's kind of like the market taking a tantrum and going down. You don't want to be freaking out with your toddler, right? Just like you don't want to freak out when your investments are down. So you want to remain calm. The trickier situation is when your kids are really, really excited. They're jumping on the bed. The last thing you want to do is encourage them to jump faster and faster and faster, higher and higher and higher.
Someone could get hurt.
It's not going to end well, okay? Maybe with your kids, because your kids are super talented.
No.
Not mine. Okay, so it's not going to end well. And so it's the same thing here. The key to not encouraging all that jumping on the bed is not trying to chase investments. Stay prudent, stay disciplined. If you really want to get into something that's exciting, some of the semiconductor stocks that have really been running, other tech companies, you want to get into those AI plays, just start legging in with a little bit of money at a time, and that way you can catch, if there's any kind of dips, you can catch those.
And I guess summing it up, it's even more vital the closer we are to achieving one of our goals.
Right. I mean, when you're close to a goal, whether it's buying a house, it's sending a child to college or retiring, you have less room for error. And so you really want to make sure that you're investing in a prudent fashion at a speed that is commensurate with where you are in terms of funding your goals. You saw this a lot of times in 2008. People thought the markets let them down when their investments into retirement. And so it's really, really vital as you're getting close to a major goal that you have your investment strategy dialed into the speed that you should be going.
Great advice, as always.
Thank you. I'm going to take my hat off. You can have the hat.
No, I don't. I'm going to mess up my hair.
Oh, no. You look good in the hat.
Mike, thank you so much. We'll be right back.